The average new car in America now costs $50,000. The average American salary? $65,000 a year. That means millions of people are financing a car that costs nearly their entire annual income. But here's what nobody tells you: the car isn't what's killing your finances. The loan is. And by the end of this video, I'm going to show you exactly how that loan is designed to keep you broke and what to do instead. I work in debt relief. Every single day I talk to people drowning in debt, credit cards, personal loans, medical bills. But you know what almost all of them have in common? A car payment. Not just one, sometimes two. And they have no idea how deep that hole actually goes. So today I'm breaking down the real math behind car loans, why the system is designed to work against you, and the smarter moves you can make right now. Back in 1963, the average car loan was 36 months, 3 years. That was it. Fast forward to today, the average car loan is 69 months, nearly 6 years. And right now, 1 in 5 Americans is taking out a loan for 84, 96, even 108 months on a car. That is 9 years of payments on something that loses value the second you drive it off the lot. Here is why this happened. In 1963, the average new car cost about $3,200. The median household income was $6,200. So a car cost about 52% of your annual income. Today, the average car is $50,000. Median income is $84,000. That is now 60% of your annual income, and cars are 56% more expensive than inflation alone would explain. So what did the car industry do? They did not lower prices. They just stretched the loan longer to make the payment feel smaller. Here is the move every car salesman is trained to make. The second you walk in, they ask you one question: what monthly payment works for your budget? The moment you answer that, you lose. Because now you are not negotiating the price of the car. You are negotiating how long you will be making payments. Let me show you the real numbers. Say you finance $40,000 at 6% interest. On a 36-month loan, your payment is $1,217 a month. Total interest paid, $3,800. On a 72-month loan, your payment drops to $773 a month. Sounds better, right? But your total interest paid jumps to $6,400. The bank makes an extra $2,600 off you just for stretching the loan. And that is before we talk about what happens when you are underwater. After just 1 year on that 72-month loan, you might still owe $26,000 on a car that is now worth $24,000. You are already in the negative. You cannot sell it. You cannot trade it. You are stuck. Let us use a real example. A Toyota Camry. $32,000 sticker price, still below the national average. You put 20% down. You finance $25,600 at 6.5% over 36 months. Your payment is $767 a month. Now add insurance, roughly $150 a month. Gas, $200 a month. Maintenance, $100 a month. You are now spending $1,200 a month on a Toyota Camry. Over 6 years, including the 3 years after you pay it off, your total cost of ownership is over $61,000. Subtract what the car is worth at the end, about $18,000, and your true cost is over $43,000 for a $32,000 car. And that is the responsible version. Now imagine doing that on a $50,000 truck with an 84-month loan at a high interest rate. I have seen people paying $1,600 a month on a Jeep Wrangler. $1,639 times 84 months. That is $137,000 for a $100,000 Jeep. Nearly $38,000 in interest alone. That is not a car payment. That is a second mortgage. Here is where it gets really dangerous, and this is what I see every day in debt relief. When you are locked into a $700, $800, $1,000 car payment every month, what happens when life hits? Medical bill, job loss, emergency. You do not have the cash because it is all going to the car, so you put it on a credit card. Now you have got credit card debt at 24% interest on top of a car loan. And the car? It is still losing value. You cannot sell it because you owe more than it is worth. You cannot refinance because your credit took a hit. You are trapped. This is the cycle I help people break out of every single day. Car loan leads to cash flow problems. Cash flow problems lead to credit card debt. Credit card debt leads to missed payments. Missed payments destroy your credit score. Bad credit score means higher interest rates on your next car loan, and the cycle repeats. The car payment is not just a car payment. It is the anchor that sinks everything else. And let me take this even further because most people do not realize how much a car loan affects your ability to build wealth over time. Think about this. The average American has a car payment their entire adult life. They pay off one car and immediately finance another. They never have a period with no car payment. That means from age 25 to age 65, 40 years, they are always sending $500, $600, $700 or more to a lender every single month. Now let us do that math. Say you average just $600 a month in car payments over 40 years. That is $288,000 in car payments over your lifetime. But here's the part that really hurts. If instead of making that $600 car payment, you invested that money into the market at a 7% average annual return, over 40 years, that $600 a month turns into over $1.4 million. $1.4 million. Gone because of car payments. That is not a car. That is your retirement. Now, I also want to talk about something that does not get discussed enough, and that is what a high car payment does to your debt-to-income ratio. This is one of the most important numbers in your financial life, and most people have never even heard of it. Your debt-to-income ratio is the percentage of your monthly income that goes toward debt payments. Lenders use this number for everything. Mortgage approvals, personal loan approvals, credit card limit increases, all of it. Here is the problem. The recommended debt-to-income ratio is under 36%. That means if you make $5,000 a month, your total monthly debt payments should stay under $1,800. Now add a $750 car payment. That is already 15% of your income gone to one debt. Add a $300 minimum credit card payment. Add a $400 student loan. You are already at $1,450 a month, 29%, before you even think about a mortgage or rent. That car payment is quietly blocking you from qualifying for a home. It is blocking you from getting better interest rates. It is keeping your financial ceiling low without you even realizing it. This is why in debt relief we always look at the full picture. It is never just one debt. It is how all the debts stack on top of each other and squeeze your cash flow from every direction. The car loan is almost always one of the biggest culprits sitting right in the middle of that pile. All right, let us talk solutions. Because I am not here just to scare you. I am here to give you a way out. Move number 1, think in total cost, not monthly payment. Take your monthly transportation budget, multiply it by 36 months, subtract your down payment. That is the car you can actually afford. If that number only gets you a used car, good. That is the market telling you the truth. Move number 2, follow the April 20th, 2010 rule. Put 20% down. Finance for no more than 4 years. Keep total transportation costs under 10% of your gross monthly income. If you make $84,000 a year, that is $7,000 a month. Your total car costs should stay under $700 a month. All in. Move number 3, buy 2 to 3 years used. A 3-year-old car has already taken its biggest depreciation hit, paid for by someone else. A 3-year-old Camry might be $24,000 instead of $32,000. That is $8,000 in savings on day 1. Move number 4, bring your own financing. Get pre-approved at your bank or credit union before you walk into a dealership. Walk in with a number. Tell them to beat it or you are leaving. This removes their biggest weapon, the monthly payment manipulation. Move number 5, never roll negative equity into a new loan. If you are underwater on your current car, do not trade it in and roll that balance into a new loan. That is how people end up owing $45,000 on a $30,000 car before they even drive it home. Look, I get it. Sometimes you need a car. Life does not always give you perfect options. But what I want you to walk away with today is this. The car loan is not just a car loan. It is a financial decision that affects your credit, your cash flow, your ability to save, and your ability to get out of debt. The system is designed to keep you making payments forever. Longer loans, higher prices, monthly payment focus. It is all built to benefit the bank and the dealer, not you. If you are already in a tough spot, dealing with credit card debt, high interest loans, or you feel like you are drowning, there are programs designed specifically to help people in your situation. Debt relief, debt resolution, even bankruptcy. These are real tools that real people use to get their lives back. Drop your car payment in the comments below. I want to see it. And if you want to learn more about how to get out of debt, not just car debt, but all of it, hit subscribe because that is exactly what this channel is about. I will see you in the next one.